Hello everyone, welcome to my show Finance Do It Yourself with your host Satisha today. Today we're going to be talking about why would a company go public. Why does a company decide to go public? Going public and offering stock in an initial public offering represents a milestone for most privately owned companies. A large number of reasons exist for a company to decide to go public, such as obtaining financing outside of the banking system and reducing debt. Furthermore, taking a company public reduces the overall cost of capital and gives the company a more solid standing when negotiating interest rates with banks. This would reduce interest costs and existing debt the company might have. The main reason companies decide to go public, however, is to raise money, a lot of money, and spread the risk of ownership among a large group of shareholders. Spreading the risk of ownership especially is important when a company grows, with the original shareholders wanting to cash in some of their profits while still retaining a percentage of the company. One of the biggest advantages for a company to have its share publicly traded is having their stock listed on a stock exchange. Advantages for a company having listed stock: in addition to the prestige a company gets when the stock is listed on a stock exchange, other advantages of the company includes being able to raise additional funds through the issuance of more stock. Companies can offer securities and acquisitions of other companies. Stock and stock option programs can be offered to potential employees, making the company more attractive to top talent companies. Companies have additional leverage when obtaining loans from financial institutions. Market exposure: having a company's stock listed on an exchange could attract the attention of mutual and hedge funds, market makers, and institutional traders. Indirect advertising: the filing and registration fee for most major exchanges include a form of complimentary advertising. The company's stock will be associated with the exchange their stock is traded on. Brand equity: having a listing on a stock exchange also affords the company increased credibility with the public, having the company indirectly endorsed through having the stock traded on the exchange. Thank you so much for watching Finance Do It Yourself. For more such videos, please tune in to mynation.com.